Ladies and gentlemen, good day and welcome to Mankind Pharma's Q1 FY24 earnings conference call hosted by Kotak Institutional Equities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Alankar Garude from Kotak Institutional Equities. Thank you, and over to you, sir.
Good morning and good afternoon, everyone. On behalf of Kotak Institutional Equities, I would like to welcome you all to the first quarter FY24 earnings conference call of Mankind Pharma. I would now like to hand over the call to Mr. Ravi Agarwal, Head of Investor Relations, to introduce the senior management and take the discussion forward. Over to you, Ravi.
Yeah, hi. Thanks, Alankar. Good afternoon, everybody. I thank you again for being with us today on our Q1 FY24 earnings conference call. On the call today, we have Mr. Rajeev Juneja, Vice Chairman and Managing Director, Mr. Sheetal Arora, CEO and Whole-Time Director, Mr. Arjun Juneja, Chief Operating Officer, Dr. Sanjay Kaul, Chief Marketing Officer, and Mr. Ashutosh Dhawan, Chief Financial Officer. We will begin with opening comments from Mr. Juneja, providing an overview of the quarter. This will be followed by comments from Mr. on business performance, followed by Mr. Ashutosh, who will share some key thoughts on the financial aspects of our performance. There will be an opportunity at the end of the opening remarks to get your queries addressed by the management. Before we commence the call today, I would like to remind you that some of the statements made on the call today could be forward-looking in nature, and a detailed disclaimer in this regard has been included in the press release that has been shared on our website. I now invite Mr. Juneja to share his comments.
Thank you, Ravi, and good afternoon, everyone, and welcome to our Quarter 1 earnings call. Let me start by saying that we started this year with a healthy note, with a strong double-digit growth in sales and profitability. If you look at our key financial parameters, the revenue grew by 18% year-on-year during the quarter, with the domestic business growing at 14% year-on-year. EBITDA grew 43% year-on-year to rupees 660 crore rupees with a margin of 25.6%, an increase of 4.5% as compared to quarter 1 last year. PAT grew by 66% year-on-year to 494 crore rupees. Our pharma segment maintained its outperformance against the IPM with the secondary sales growth at 12.5% as against IPM growth of 8.5%. I'm happy to share that our chronic segment share stood at 36% during this quarter as compared to 34% last year. This is the highest chronic share we have achieved in our business, and to just put in perspective, chronic share in FY18 was around 28%. In fact, you'll be pleased to know that as per IQVIA, the cardiovascular segment has replaced anti-infective to become our largest segment in our mix in this quarter. This is a testament of our commitment to increasing our presence in more profitable chronic therapy area. These segments have a strong growth profile given the rising prevalence of chronic diseases due to lifestyle changes and rising income level in India. This will require a more top-down approach with focus on widening our footprints in metro and class 1 cities. I will specifically mention our campaign to promote DMF quality medicines in India have been truly disruptive, and we have seen outstanding response to this initiative. We already have more than 100 SKUs within this initiative currently, and we are rapidly expanding our product offering with this very important service to the country. In our consumer healthcare segment, we maintained a dominant brand leadership in respective categories with 4 of our brands ranked number 1 in their categories. The secondary sales have been very, very healthy across most new brands, and we expect the full year growth in this business to be the similar level versus last year. On the R&D front, our successful launch of dydrogesterone reiterates our commitment to being a science-based company. We are focusing on product innovation, novel drug delivery system, strategic partnership with innovators to strengthen our product offering that will give us competitive edge. I would like to conclude by re-emphasizing our strategic priorities going ahead. We'll continue to remain domestic focused. I again say domestic focused with emphasis on volume-led growth through our affordability proposition. We'll continue to garner dominant leadership position in identifying white spaces in key chronic therapies through in-house R&D, acquisitions, in licensed products. Finally, we'll continue to aggressively invest in marketing to create and support our dominant brand leadership across pharma and consumer business. If I just sum up my whole commentary, I will say that certain points you must need to really understand that Mankind is focusing only in India, number one. Number second, we're a mass consumer coverage. 5 lakh doctors we cover. Important point to note that our volume growth, which is 4.3%, versus IPM growth, which is just 1.4%. We're quite good in that. Chronic share of Mankind has come to 36% versus 34% last year. Cardiac share, specifically I'll say, in Mankind is 13.8% versus industry's 12.6%. And of course, for the first time, cardiac has outperformed our anti-infective segment. And market share of Mankind has grown 4.4% from 4.2%. Certain things, certain initiatives we have taken, and that basically one is that we have launched more than 100 SKUs in DMF, which would be very disruptive in the market because seeing the threat of branded generic in the market, we just want to create a different kind of a category, which is called DMF grade. Who does not want to have international quality medicines at Mankind prices? Whatever is available in most developed countries should be in India. That basically is our focus. In our new initiatives, we have launched insulin, and in just 2-3 months' time, 7,000 patients basically have come on our insulin Nobiclar. In whether it's a CNS, we're focusing a lot. In respiratory, if you remember very well that we took Combi Hail from Dr. Reddy. That's giving us a 30% growth. If you talk about Daffy, we took from Dr. Reddy again, 30% growth. These are growing phenomenal. Our transplant business is also growing at a 66% this quarter, first quarter. Panacea growth in the first quarter is 22%. Secondary growth I'm talking about. Primary is even better. We reiterate that we'll always outperform IPM. Our EBITDA margin would be in the range of 24 to 26%. This is what is the summary. So now let me hand over to Sheetal.
Good morning and thank you, Rajiv ji. Welcome to today's investor call. I am delighted to provide you an update on our domestic business with a specific focus on our consumer healthcare segment. Let's begin with our domestic business revenue, which reached 2,419 crore rupees in the first quarter of financial year 2024, reflecting an year-on-year growth of 14%. According to IQVIA, our secondary sales growth for the quarter was 12.5%, outperforming the industry's 8.5% growth by 1.5 times. It's worth noting that our historic annual growth performance has consistently been 1.3 to 1.4 times the industry growth rate. Additionally, IQVIA reports that while we maintained our market rank of 4th in value terms, our market share increased to 4.4% in quarter 1 financial year 24 from 4.2% in quarter 1 financial year 23. When we consider CVM, we find we have maintained our second position during the quarter by value. I am also happy to share that penny share revenue shows a healthy growth of 22% year-on-year during the quarter, as indicated by IQVIA. The price and volume growth metric shows we continue to significantly outperform the IPM as far as volume growth is concerned. According to IQVIA, Mankind volume growth for this quarter was 4.3% as compared to IPM growth of 1.4%. This represents an outperformance of 3.2 times. This success can be attributed to our wide distribution network, large field force, and strong presence among more than 5 lakh doctors, making us the industry leader. We firmly believe that volume-led growth reflects the superior quality of our sales, since it is driven by prescriptions and is therefore more sustainable. Our prescription share reflects this well, 15.4% during this quarter as compared to 15.1% at the same time last year. In fact, our subscriber penetration has also increased from approximately 81% in quarter 1 financial year 23 to around 83% in this quarter. I am delighted to share the remarkable progress in our business strategy, particularly in expanding our presence in chronic segment. This quarter has been exceptional. Our chronic share is now at all-time high of 36% within the company. Significantly, our chronic business has experienced a phenomenal growth of 17% this quarter, outperforming the IPM growth of 10% by an impressive 1.7 times. In our consumer healthcare business, we proudly announce that we achieved revenues of rupees 208 crore in the first quarter of financial year 24, representing a growth of 8% year-on-year and 37% quarter-on-quarter. Our key brands, Prega News, Health OK, and Manforce Condom have witnessed substantial growth in secondary sales with a remarkable year-on-year increase of 30%, 23%, and 11% respectively during this period. Over the longer term, our compounded annual growth rate has been strong 22% from financial year 21-23, and we are confident of sustaining strong growth in this segment as we surge ahead. These achievements are testament to our team's dedicated efforts and the effectiveness of our approach. With our team passion, commitment, and customer-centric approach, I am confident that we will continue to thrive and achieve new milestones in coming quarters. We look forward to our customers' continued trust in our product and affirm our dedication to improve their life. Now I will hand over to Ashutosh Ji, who will provide further insight into our financials. Thank you so much.
Yes. Thank you, Sheetal Ji. A very good afternoon, and I would like to thank everyone for taking out time and joining us on this quarterly earnings call. I hope all of you would have received our financial results and the press release. Let me give you a brief on the financial highlights for the performance during Q1 FY24. The revenue from operations increased by 18% year-on-year basis to rupees 2,579 CR as compared to rupees 2,180 CR in the previous period last year. EBITDA has shown a growth of 43% year-on-year basis to rupees 660 crores with the margins of 25.6% as compared to rupees 460 CR with margins of 21.1% last year in the same period. There is an increase in the margin of 4.5%. This increase of 4.5% is largely driven by 2.8% increase in the gross margins from selective price increases, which we have taken in the previous quarters, stable API prices, and the favorable sales mix changes. The gross margins are now at around 68.2% level as compared to 65.4% in Q1 last year, and these margins were 67.2% in Q4 FY23. The R&D expenses for the quarter was at 2.1% of sales, which has been within the range of 2 to 2.5%, which we had communicated in our last interactions. The depreciation and amortization expense for the quarter were at 87 crores as against 78 crores last year in the same quarter. Our tax rate for this quarter was at 20.9% as compared to 21.6% in FY23. The PAT for the quarter was at 494 crores, representing a growth of 66% Y-on-Y basis and 68% on quarter-on-quarter basis, with diluted EPS of 12.1 per share of rupee 1 paid. The cash EPS, that is the EPS adjusted for non-cash items like depreciation and amortization, was at rupees 14.3. On a trailing 12 months period, our net working capital days were at 39 days as compared to 45 in FY23. The capex, including capital work in progress, was at rupees 111 crores in Q1 FY24. The cash flow from operations has shown a significant increase to rupees 488 crores as compared to the negative 161 CR in Q1 FY23. The company has a healthy net cash position of rupees 1,727 crores as compared to 1,366 crores as at 31st March 23. The return on capital employed ex cash basis and return on equity ex cash basis has shown an increase to 28% and 25% respectively on 12 months trailing basis as compared to 25% and 23% respectively in FY23. For FY24, we expect to incur rupees 550 to 600 CR in the capex. The EBITDA margins are expected to be in the range of 24 to 26%, as mentioned in our previous interactions. With this, I would like to conclude our opening remarks, and we will now be happy to address any questions that may have, please. Over to you.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star then one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kunal Dhamesha from Macquarie. Please go ahead.
Thank you for the opportunity and congratulations on the fantastic set of numbers. So the first question on our profitability guidance, while we have guided for 24 to 26% for this year, would you be able to provide some guidance, let's say 2 year, 3 year down the line, where we see, because obviously we are growing very fast in the chronic therapies and generally that is where a lot of delta in terms of profitability could happen. So any color there would be helpful.
Okay, yeah, thanks Kunal for the question. So as we mentioned that the guidance is 24 to 26%, and there are operating leverages which are available, and we are quite hopeful that going forward we should be able to maintain and increase our EBITDA margins from the existing levels.
Sure. Would you provide some color as to, obviously we have pricing lever, etc., but let's say between pricing, operating leverage, which could be the, driver, which could be the major driver for us, let's say not for FY24, but beyond FY24.
So Kunal, there is increased focus on the chronic business, as we mentioned, and as you're aware that chronic business has higher gross margins. So as and when the share of the chronic business continues to increase and it is outperforming the IPM, we expect the gross margins to go up from the current levels. Also at the same time, we've launched about 10 to 12 new divisions in the last couple of years, where their productivity is less than the average productivity of the established divisions of Mankind. There we expect the operating leverage to improve upon, which will enhance our margins further.
And Kunal, I'm Sheetal said, if you see historically, in financial year 22, our chronic share was 32%. Now in first quarter it is 36%. There's a jump of 4% in our chronic share. So definitely going forward, it will outperform the market and EBITDA margin will grow.
Sure. So,
Mr. Kunal Damesh, I'm so sorry to interrupt. Requesting you to please speak a bit louder as the management can't hear you well.
Sure, sure. So just to follow up on that, we have been telling that our chronic would grow, very fast, and I think, we have done that in the past. But let's say over 2-3 years, would you have any internal aspiration as to increase our chronic to certain level as a business mix?
So what basically is the aspiration? Aspiration is to become the most admired, most respected institution. I mean, that's it. We basically believe in them in good karma, good working, and we have always done in the past as well. Rest is in front of you. It's always good to have good people, good leadership, good processes, right products. So when you mix up all these four things, I mean, good things really happen.
Sure, sir. Thank you. And my last question is on the MR side. How many people would we have employed right now? I think earlier we used to give that in presentation, or I might have missed it.
So, Kunal, this is Sanjay Kaul. So we have MR count of around 11,000. So that excluding the managers, 11,000 plus. It excludes the managers, and that's the number we have at present.
Sure. I have more questions.
So the exact headcount for the quarter for the MR is 15,400, which includes the managers as well as the MRs.
Okay, perfect. I have more questions. I'll join back the queue. Thank you.
Thank you. Before we take the next question, I'd like to remind participants to please limit your question to 3 per participant. You may rejoin the queue for a follow-up. The next question is from the line of Amit Kadam from Canara Robeco Mutual Fund. Please go ahead.
Yeah, thank you for giving me this opportunity, sir. So my
A bit
first
loud.
question is... Hello? Hello?
Yeah, please be a bit louder. We can't hear you.
Okay. I'll try once again. So, thanks for giving me this opportunity. So, just first question is on the consumer business. This quarter we clocked 8% kind of a growth. Historical growth has been quite higher than this. Can you throw some light on this? How do we look this segment growing ahead? And what has led to that 8% thing? Was it some like a high base of last year, something like that?
So Amit, so we always believe that everything has to really happen annually or 2 years, 3 years, like quarter to quarter. It's very premature. I mean, having said this, last year first quarter base was very, very high, and last year it was a negative kind of a quarter, and last year was we had a growth of 25%. That's one reason, but we are very confident that whole year will be doing as we have done in the past. We're very sure about this. Our major products, main products are performing very good. The growth is around 18%.
Then how do we see this?
If you look at the secondary sales for the consumer business, so that has fared very well. So that has been more than the industry average. It's only the primary sales which is reflecting lower because of the high base. But on secondary sale basis, all the key brands, they have done fairly well.
Right. So, do you want to guide something on this, like based on your historical growth rate? Should we for the year be upwards of 20%?
Amit, we can't hear you very well. You have to be a bit loud.
Sir, I am asking you, like, can you guide something for this year, like the based on our historical run rate, like for this FY?
Same like what we did last year.
Okay.
Approximately same like that last year. So that's the guidance.
It was last year. Yeah. So we will be similar to those levels of last year, which was 17% last year.
Sir, second question is on the working capital. We saw a remarkable improvement there, almost like we have dropped to now 40 days. What has led to that particular thing, and how do we see this thing going ahead for the full year?
So historically, if you see that our working capital days have been closer to 40 days. So we have been able to bring it down to our historical levels. For the last year and the year before, there was a spike because of supply chain and other issues. So now we are back to our historical level of 40 days. We have been able to bring down inventory back to our normal levels, historical levels.
Okay, great. And just third question is on the you touched upon insulin and your early success into it. So can you just throw some light on what kind of opportunity, what kind of maybe sales what we can garner in this particular market, and what kind of opportunity what we can see in this particular segment? Yeah, that's it.
We launched this insulin, only in the month of May, right? These are very initial days, but every month we are adding around approximately 2,000 patients. In an insulin business, the number of patients you add, that becomes your revenue going forward. So if you compare with other companies adding 2,000 patients every month, it looks quite good to us.
And how do we see this thing going ahead? Like the way we have almost.
So we already have said that our focus is towards chronic side. Anywhere we get an opportunity towards chronic side, we go for it. And we, as you can see yourself, that chronic share is continuously increasing. So we are quite optimistic that we'll do quite good in this. And more opportunities will come in different collaborations as well.
Okay. Thank you, sir. All the best.
Thank you. Reminder to the participants to please limit your question to 3 per participant. The next question is from the line of Nikhil Mathur from HDFC Mutual Fund. Please go ahead.
Hi, good afternoon. Sir, am I audible?
Yeah.
Yes, sir, you are.
Okay, sure. So the question I have is that the exports business has seen a dramatic jump on a YY basis. From 51 crores, the company is now at 160 crores. So can you highlight what has driven this?
As we mentioned in the past also, that we continue to file differentiated products into the US. These differentiated products bring us some good opportunities. But having said that, our focus continues to always be on the Indian domestic market, and we'll continue to leverage that.
Sir, does this jump has anything to do with the shortage scenario that we are seeing in the US because of various reasons? Does it have any role to play here?
It's not because of the shortage scenario. It's just because of the differentiated products that we filed. As we mentioned, there are certain ophthalmics, injectables, and certain products which are backed by our own API, which is leading to this phenomena.
Okay. So you see this run rate maintaining for the ensuing quarters, and the same can be extrapolated to coming years as well. I mean, growth should be built on what the run rate is in this particular quarter. Is that how we should look at?
It's very difficult to predict the US market like this because you know how volatile it is. So it will be very difficult for us to predict how the runway would look like. I mean, but having said that, there will be a few months of opportunities that we see going forward.
Right. And sir, just final question tied to this. Sorry to harp on it a bit more. So now we are looking at exports at around 6% of total sales versus 2% last quarter. Although there can be quarter-on-quarter variation, so I'm not trying to replicate the same mix for the coming quarters as well. But would you like to give some medium-term guidance as to what kind of exports to domestic revenue mix we are looking at, let's say 3 years out, 5 years out?
I mean, while the export business is growing, but the revenues from the domestic business would contribute more than 90% going forward.
Right, got it. And one final question, sir. The growth has been pretty strong in domestic despite various secondary agencies reporting data which was looking a bit underwhelming. And I think the season picks up in 2Q itself. So can it be safe to say that 2Q is likely to be better than 1Q and the agencies were not properly able to capture the data? Would you like to call out what's the reason there?
So, if I understood you correctly, Q2 always is a bigger quarter in comparison to the first quarter. So it is solely because of outbreak of basically infections in quarter 2. So it is always a bigger quarter in comparison to the first quarter.
Okay, got it. Thank you so much, sir.
Thank you. The next question is from the line of Harsh Bhatia from Bandhan AMC. Please go ahead.
Yeah, good afternoon. Thank you. I hope I'm audible.
Not audible.
Requesting you to please speak a bit louder, sir.
Yeah, is this better?
Yes, sir.
Yeah, just to expand a little bit on the human insulin product, the Nobeglar, I just want to understand the go-to-market strategy as a whole.
Repeat again. We missed the first part.
Yeah, just to understand a little bit more on the human insulin product, the Nobeglar, that you launched in May. Just to understand a little bit better in terms of the go-to-market strategy, the pricing aspect, because this is a little bit more concentrated market as a whole, because we have MNCs operating at that level, right? So maybe your views on how you're looking at the market. I understand that it's just been 3 or 4 months since the launch period, but maybe a little bit more color would be helpful.
See, I mean, from last number of years, our aspiration was and is to become a leader in chronic side, whether it's a cardiac side or diabetes side or respiratory side or anywhere. Anywhere there is a lifestyle disease problems, you are supposed to be there, because that gives us consistency, more profitability, and whatever number of prescription you add, that gives you growth. So keeping the same in mind, we have launched, and it's basically insulin glargine, not the regular insulin. That insulin basically we have launched, and as the name, I mean, as our penetration in bigger cities, topmost doctors, I'll not say bigger cities, top of the top doctors is increasing. The response is coming very good.
And this initial response
we all know that India is the epicenter of diabetes. So we feel that we should be very, very strong here. Keeping the same in mind that we took this Panacea because they have product like Glyzid. That's one reason.
And also on the insulin front, we are also conducting clinical trials on the aspart. And those trials, we expect them to be over in the next 10 to 12 months. So we're looking forward to launch the aspart version also next year.
Sure. And the 7,000 patients would be a blended mix of metro, non-metro, or the primary orientation would be from non-metro as of now?
So it's always a mix. Always a mix. I mean, but I will definitely say that more towards metro side.
Sure. And on Panacea Biotech, are we giving out the current quarter run rate? Because we have given out the growth rate number. At the time of acquisition, the analyzed run rate was somewhere around 200 to 250 crores. But what would be the current run rate, quarter run rate?
In the current year, please. So if you talk about Q1, as per IQVIA, the secondary number is 75 CR for Q1.
Sure. That's helpful. Thank you.
Thank you. The next question is from the line of Bansi Desai from JP Morgan. Please go ahead.
Yeah, thank you for taking my questions, and congrats on good set of numbers. My first question is, on the impact of, ban on our brand, Codistar, which we had in the month of June. So if you can just call out what could be the potential impact there, and did we see any write-offs pertaining to that brand in this quarter?
So what we have done basically, we are building a portfolio in dry cough with a very, very innovative product that we acquired from Panacea. So we are basically we have already launched dextromethorphan and combination in adults, in pediatrics, and also we have basically acquired a very innovative mouth disintegrating tablet from Panacea last year, and that also is a game changer. So we are promoting very aggressively these prescription-driven brands to doctors, and we believe in the coming months this business is going to grow substantially.
So just to close the loop on this, with regard to the write-off, it has been negligible in this quarter. It's less than 10 million rupees.
Okay. And so fair to assume that a large part of this brand revenues should be kind of, recouped with sales growth in other brands.
In the long run, yes.
Okay. And my second question is, Rajiv, you've spoken about, having this DMF grade APIs. So what is the longer term plan here? Do you see this increase materially going forward, as a percentage of our sales? Do we see more and more APIs which are of this quality? And if that's the case, how should we think about, cost of manufacturing these?
So till now we have introduced 101 products in DMF. So our objective is to introduce 15 to 20 brands every quarter. So that is what we intend to do, and these products are mainly from semi-chronic and chronic therapy areas. I hope I answered your query.
Got it. And my last question is, on the utilization of cash that we are going to accumulate, over the next few years. We are generating almost 2,000 crores plus of cash from operations, while our capex needs are closer to 500-600 crores per annum. So how should we think about deploying this excess cash that we generate over the years?
So at this stage, we would like to be a bit conservative with regard to the cash aspect. So the first priority is that wherever any good opportunities are available with regard to M&A piece, so definitely we will be utilizing the cash towards that. And capex also around 500 to 600 is what we are planning for this year, and we will take a view in the next few quarters with regard to the dividend payout as well.
Okay, and on the M&A bit, would you be open to acquire brands in the consumer healthcare space as well to grow that business?
Two sides, we are absolutely open. One is consumer side, the second is chronic side. Two places we are very, very open. We have said in the past as well.
Okay, noted. Thanks a lot.
Thank you. A reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. The next question is from the line of Neha Manpuria from Bank of America. Please go ahead.
Yeah, thanks for taking my question. Just going back on the export number, I see in the presentation that we have mentioned there is certain one-off opportunities, to the US. Is this what you're referring to in terms of this continuing for a couple of more months or quarters, or is it truly one-off? And if you could quantify that, if it's meaningful.
It will be difficult for us to quantify these numbers, but this will continue for the next few months. Understood. That's helpful. And second, if I were to look at our cost, both on employee and other expenses, we seem to have seen a fair bit of increase quarter on quarter. In the employee cost, do we have any one-off, non-recurring payout, etc., during this quarter? And therefore, what is the normalized level we should be assuming? And similarly, on the other expense, what's the level of spend that we are looking to, incur as we focus on expanding chronic and the consumer healthcare business, with the growth aspiration that we have?
Okay. So with regard to the employee cost, if we compare, so we have added close to, on a year-on-year basis, if you compare, so we have added close to around 1,000 people. Having said that, the MR addition has been less than 5%. That's part one. With regard to the one-off, we have launched the ESOP scheme. So in this quarter, there is an impact of ESOP cost, which has come in as compared to the previous quarters. Yeah. And with regard to the other expenses, you have seen a spike because we are investing into new businesses as well. So that's also getting reflected in this in the other expense portion.
So, sir, on the other expense side, as a percentage of revenue, what would you consider as being, given the investments that we have planned, what would be an ideal level of, investment from another expenses perspective?
So just to, instead of getting into a quarter-on-quarter EBITDA margin,
for an annual, sir.
We have given a broad guidance that our EBITDA margins will be in the range of 24 to 26%. So we will be able to maintain our costs within that range, so that we are able to maintain that margin of 24 to 26%.
Understood, sir. Thank you so much.
Yeah.
Thank you. A reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. The next question is from the line of Rahul Javani from IIFL Securities. Please go ahead.
Hi, sir. Thanks for taking my question. Sir, can you talk a bit about the seasonality which you typically see in your India business? So while Q2, Q3 could be stronger quarters for us, but do you see a significant sequential decline in fourth quarter?
Mr. Rahul, this is Sanjay Kaul. In the last 5 years, our chronic contribution has, if you talking about Mankind, it has increased from 28 to 25%. With increasing contribution of chronic in the next 5 to 6 years, impact of seasonality will be reduced to some extent. Having said that, if you ask me this year, yes, there will be definitely some impact of seasonality on quarter-to-quarter basis. Quarter 2 is always going to have more impact of seasonality as compared to quarter 3 and quarter 4.
But if you look at our track record, first 6 months are always 51, 52% versus second 6 months are 48, 49%. That is how we maintain it. So if you just see as a whole year, first 6 months, 51%, 52%, and rest is last 6 months. That is how we are doing from last couple of years.
Sure, sir. So that seasonality would imply that our second half margins also would tend to be on the lower side versus the first half margins.
See, as chronic sales increases, that impact goes down.
So it will be in proportion to the sales seasonality part. But having said that, since the chronic portion is increasing, so therefore this seasonality impact is also weaning away.
And also in the second quarter, the sales of the anti-infectives go up, where the gross margins are lower, whereas in the later half of the year, the sale of chronic products is more. So it doesn't have a negative impact on the gross margins and the profitability as a whole.
Sure, sir. And just on the gross margins, can you talk about the differential in gross margins between the domestic and export business? And why I ask that question is, had our export business not grown to the extent which it did during the quarter, would our gross margins would have been higher, given that the chronic revenue share has also increased to 36%?
So Rahul, we have shown a betterment in the gross margins. So there has been an improvement of 2.8% over the last year.
I was referring to quarter on quarter that adjusted for the COVID provisions of last quarter. If we see, our gross margins have remained broadly flat quarter on quarter, despite some sort of an inch up in chronic revenue share. So would export business be a lower gross margin business for us? And if you can quantify, what is that differential?
So directionally, yes, export business do have a lower gross margin as compared to the domestic margin, or if you compare it to the chronic margin. As we said that the focus is on the domestic piece and to structure the business in a manner, and we are confident of maintaining the gross margin around 68% level. So that should give you the confidence that whatever is the mix changes, on an overall basis, we are confident of maintaining it to be around 68%.
And also to reiterate that more than 90% of the revenues would come and still come from the domestic business. So the margins of the export business become insignificant and don't have an erosion effect on the domestic business margins.
Sure, sir. And the last question from my end would be on the ESOP scheme which you referred to. So can you quantify the costs which you will have to incur, as in which you have incurred this quarter, and what you need to incur over the next 2 to 3 year period?
That we can share with you after the call. Right.
Okay. Sure. Thank you. That's it.
Thank you. The next question is from the line of Kunal Dhamesha from Macquarie. Please go ahead.
Thank you for the opportunity again. So the question on our campaign on the DMF grade quality, how that campaign has kind of moved for us. What is the response from the healthcare practitioners? Are we seeing whatever new product launches we have done? Probably, is there a metric that you would track that growth in these products are 2x, 3x, or whatever that be versus the normal product launches? Any color there would be helpful.
Kunal, very interesting question, but that's my favorite side. We are very sure that going forward in coming years, DMF will disrupt in pharmaceutical market. Because who doesn't want to have international quality, purity, 99% plus purity drugs at an Indian price, and forget Indian prices, Mankind prices. So this basically helps our marketing team a lot in penetrating, entering topmost doctors' chambers. And again, Sanjay has already mentioned that first target basically is what? Going for chronic and semi-chronic products. We are very hopeful, and it has also been mentioned that every quarter we wish to launch 15 to 20 new DMF SKUs. So you can imagine yourself how bullish are we. We are getting fantastic response. We ran a campaign on Burj Khalifa. That really shows our seriousness for this DMF. That really shows our conviction in DMF. But we see in future that on one side, branded generic means DMF brands in coming years. That's the kind of a confidence we have got.
Sure. So, sir, I understand that, at this point, since you have just launched the campaign, but would you kind of, at some point, would you start sharing probably, the uptake or the, revenue from that bucket? I think that would help us understand, the impact in a much better way.
So, Kunal, I think these are still early days on the DMF. We just started with the campaign, and we are in the process of launching newer products, more and more products every quarter. And I think at an appropriate time, we'll take a call if we wish to disclose the revenue separately or not.
Kunal, I'm sure. If I can add, right now, see, we are the first company to launch DMF product in India. Even the most of the doctors are not knowing what DMF is. So, a lot of marketing campaign we are doing. So, in the time to come, when the awareness will come, people will know, our customers will know, then definitely the impact would be huge. Because awareness is important right now about DMF.
And just to add to this, it will be very difficult to quantify this as well, because some of the old brands or SKUs, they get converted into DMF. So that's also, already they have sales. So how much incremental is coming because of this particular action? So that is difficult to quantify or break it into that, because there are multiple factors which go for the increase in the sales. So
thank you. So that was again my next question, because Sanjay sir said that we are in the process of launching 15 to 20 DMF grade products every quarter. So my question was, probably how many of that would be our existing products and how many could be the new products? Or not on a quarterly basis, probably a yearly basis, 2-year basis.
So see, it will be 80 to 85% our existing range getting converted into DMF, and new products in chronic and semi-chronic, we will surely bring in DMF. That will be around 10 to 15%.
Perfect. Thank you, sir.
Thank you. The next question is from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity. So just on this dihydrogesterone plant, as it's been highlighted that it would be commercialized in first half FY24, the operational cost is more or less there in this quarter itself in terms of expenses?
No, currently we have it's forming part of capital work in progress, so of the Udaipur plant.
Okay. So, how much this will get added as in the coming quarters?
So in terms of capex spend, till now we have spent around 310 crores on the Udaipur plant, which will be getting depreciated in the subsequent quarters. From this quarter, we are hopeful that the commercialization and the capitalization will be getting completed. So it will be coming in the depreciation.
And on the operational cost side, sir?
So on the operational cost side, the plant where dydrogesterone is being currently manufactured, it will be transferred to the new plant in Udaipur. So we don't see a significant rise in the OPEX cost.
Rather, it will be beneficial on the gross margin or the cost of goods sold.
Understood. And so this quarter would have had some impact of these lower prices on account of NLEM as well, correct?
No. I mean, as you are aware, Mankind, from a portfolio of the products, we are the least affected in terms of the NLEM products. So the impact is very minimal.
Understood. And given that this Dydro OPEX is not going to be significant, while this could add for sales, your exports is in which case ramping up. Given that 2Q is going to be much better as it has been historically. So if I sum up these things, 24 to 26% EBITDA margin guidance seems to be conservative. Any comment on this? We are already at 25.6% EBITDA margin for first quarter.
I'm sorry, Kun.
I think the reason here is that, because of the seasonality impact of Q2 going up and the sales of anti-infectives rising, and which have slightly lower gross margins, and then the chronic sales increasing in the second half of this year, I think we would like to be consistent with our gross margins as the guidance which we've given.
Okay, sir. Thank you. That's it from my side.
Thank you. The next question is from the line of Nitya from Bernstein. Please go ahead.
Yeah, hi. Thank you for the opportunity. Just a couple of questions for me. One bookkeeping question. So when you talk about DMF grade, are you referring to US DMF grade? Are you referring to specifications as laid down by the US FDA? And the second is US DMF grade API, I'm sure, are more expensive. So are you looking at the new products therefore being margin dilutive?
Sorry, you missed the last part of your question.
So the question is, US DMF grade API is more expensive than, let's say, a non-US DMF grade API. And therefore, is your incremental sales therefore margin dilutive for you, and to what extent?
So what we are referring to here is the US DMF and the European CEP grade APIs. Yes, the cost of these APIs is slightly higher than the cost of the non-DMF grade. So in certain products, there is a decline in the gross margins by 1 or 2 percentage points. But we are compensating for that decline by way of price increase which the government allows to the tune of 10% year on year. But there are also certain products which we are manufacturing in-house, the APIs, and filing the DMFs of those products. So I would say there is not much of a cost impact on the DMF grade products that we are using.
Thank you so much.
Thank you. The next question is from the line of Neelam Punjabi from Perpetuity Investment. Please go ahead.
Thanks for the opportunity. My question on the previous participant's question on dydrogesterone.
Please be louder. We didn't hear you.
Sure. So is my voice more clear now?
Yeah.
So my question is on the dydrogesterone API. Could you please highlight what's the potential of dydrogesterone globally in terms of capacities, in terms of tons, and what is the annual capacity of dydrogesterone that we are putting up?
So we have a capacity of dydrogesterone of manufacturing 400 to 500 kilos per month. So that would be approximately 4.5 to 5 metric tons annually. and the demand for dydrogesterone globally is somewhere around 4 to 4.5 metric ton. And this demand is increasing because this molecule is growing across the globe. And as and when new entrants are also launching, the market size is increasing, which we've seen in India itself.
Got it. So our capacity of 400 to 500 kilo per month is on the expanded capacity, right?
Correct. The current capacity that we have, the infrastructure that we have is capable of going up to 400 to 500 kilos a month. Our current capacity is in the range of 200 to 250 kilos per month.
Understood. That's helpful. Thank you.
Thank you. A reminder to the participants, if you wish to ask a question, please press star then one on your touchtone telephone. The next question is from the line of Alankar Garude from Kotak Institutional Equities. Please go ahead.
Yeah, hi. So first question is, has there been any impact of the FDC ban on Codistar in this quarter?
I think this question has already been asked, Alankar, but there has been no impact as such on the Codistar ban. We are negating the impact of Codistar by launching newer products in the similar segment under the brand of Codistar itself in the form of dextromethorphan and also the tablet that we acquired from Panacea. So we see in the next few months this impact will get negated.
Understood. And the second question is, can you talk a bit about the trade generics business? How seriously are we approaching this particular vertical? How big is it for us right now? What's our approach?
So, we're quite serious in this. Our trade generic would be doing around, last year it did how much?
200
200 crores rupees. Hopefully this will do 250 to 60 this year. But we have a long-term reason for launching that product, that going forward can we shift some products which become used to customers' habit to bring in our OTC side. That's a basically more intangible long-term plan.
And have we invested in terms of any field force dedicated to this, or the numbers are quite small at the moment?
Yeah, absolutely.
So it's close to around 200, which are sales force for this business.
Understood. Thanks. That's it from my side.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference back to the management for their closing comments.
Yeah, thank you everyone for joining us on the conference call. We really appreciate you taking out time for our earnings call, and we look forward to interacting with you going ahead as well. Thank you.
Thank you. On behalf of Kotak Institutional Equities, we conclude today's conference. Thank you all for joining. You may now disconnect your lines.